All righty, Doc here from North America. Good morning, good afternoon, and good evening. Didn't realize it had drifted. The time had drifted, and here I am. All right, let's get over to the chat line too, because I just realized it's a minute and a half after it normally starts. So let's see if anybody's up on the chat line at the same time. I feel real bad now. Oh, we do. We have some people. Oh, I see. No questions asked at the moment. Where Monday was really something. We had like 4 questions and people saying, "Hey, how you doing?" It was it was very surprising. So Monday, that everybody kind of woke up and saw what was going on. But anyhow, there we go. You can see the dollar. You know, it's we got the Swiss up there. The dollar Swiss pairs trade. And you can see moving down just a tad. Nothing major. You see over in Chicago quant. You see the opposite. Not the opposite, but what it is it is just a little bit down also at the same time. Where's that mouse at? Right up there. There we go. So you can see here, let's move that over like that. There we go. And you can see right here on the Chicago quant, it's just down a little bit, just an edge, you know. You can see yesterday down a little bit more. You can see how tight this is getting right here. I mean, just enormously tight. Usually that starts a new trend when you get that tight. And you can see over on the J4X, same situation, it's moving down. Maybe what it will do is make a higher low here and try to turn back up, or maybe they'll go visit the 50 percentile. But the world seems relatively sanguine this morning. You know, we have troops. What, as Giannis and I were talking about, boy, you know, if I was Putin, I would bivouac. I would build bases all along that property there, and you know, just enjoy the idea of higher oil prices for a bunch of years. You know, really. Giannis said it best yesterday. The Russian defense budget, which is a little bit smaller than the Chinese one, is about $45 billion, which is amazing. You know, I mean, I think the Chinese one is 78 billion. Now, I'm sure they're spending more money than that, both of them. You know, but the thing is that that's their published defense budgets, and the United States is I think it's something like almost $1 trillion. I don't know how anybody can take this situation. So I'm laughing how they take the situation so dire. I guess it would be the word dire. Dire's a good one. You know, in other words, taking it seriously on a. I can understand taking it serious, but I don't think I would take it to heart. You know, I think that when you're only spending 50 billion or $100 billion on defense, and the United States is spending close to $1 trillion. And who knows what the Central Intelligence Agency is doing? That's totally separate on its own. Remember, they put a spy satellite up in the sky, allegedly, 10 years before Sputnik. But it's always just a rumor. But they did. Remember, NASA did start at CIA in Langley. So. End result is that Mr. Putin pulled 10,000 troops out yesterday, and things are getting a little bit calmer. And hey, Jordan, would you like to discuss the futures market and how it works? Sure. Let's discuss about the futures market and how it works. We're looking at the spot market right now on Swiss. So choose a future, and we'll discuss it. Would you like to discuss like a future contract on currencies, or a future contract on commodities, or futures contract on indexes, or how would you like to have that conversation? I'd gladly look into it. I'm going for a sip of tea. I'm waiting for your answer. Where is my tea? Oh, there it is. So you're talking about the actual physical futures contract, how it works, how it expires, how the delivery works. All comes down to the individual contract. So in other words, if you're looking at West Texas Intermediate, I think they have 2 delivery points. One is the hub down in the Gulf, and then they have one in New York Harbor. Bond futures. Okay. Oh yeah. Oh man, I love that one. Bond futures. That is the Wild West. We talked about that last week. So in other words, when you're looking at the 10-year note or bond that's trading in the United States in the futures contract, so is bonds a future? Bonds are a bond. Futures are a future. A bond, there's bills, there's notes, and there's bonds, and I guess you could say there's tips. Okay, and tips are Treasury, um, inflation products. That's why they call them tips. Treasury inflation products. And what they do is they have no yield defined, whereas bonds and notes and bills, they sell their bond, they offer their bonds, bills, or notes, depending on the life of them. So a bill is like short term, like 2 year, I guess it's 90-day bills. So there's a 30-day, there's a 60-day, there's a 90-day. You can buy any one of the three. It's a short-term bill investment tool, where they'll pay interest. Well, in the old days, they all guaranteed paying interest on something, in the sense of the backing of the name of it. Nowadays, you have bills that come out like the German Bund 30-day is a minus. Matter of fact, the 10-year is a minus. No, so they don't pay any interest at all on them. You have to pay them interest. Still learning so bonds at a future. A future contract is a forward contract that is going to expire. So in other words, you can have, like right now, the 10-year bond has a contract, and it might be only like 2 years old. That the futures contract is 2 years old. And what it does is it delivers 10-year bonds. Okay. Matter of fact, notes and bonds kind of are the same thing, but their time duration. So in other words, after bills, then there's notes, and then from notes there are bonds, and they kind of commingle. So there are 7-year bills and there are 7-year bonds, and they're the same thing and they're yielding the same price and so forth. And it's just a delivery thing, and then it scales and goes into bonds, and then bonds from 10 years on. Any money floated by the Treasury is a bond, and it goes all the way up into the 30 or 40, whatever your 15-year, 10-year, 15, 20, 30-year bonds. And then there's tips, which were created during the inflation years back in the 80s. That would the Treasury would not define its interest rate. See, when you create a bill or a note or a bond, it defines the length of the bond, how long it will last, if it's 30 days or 60 or 90 or 2-year note or a 5-year note or a 10-year note. Or then you jump into the bonds, and then it's a 10-year bond, 15-year bond, 20, 30-year bonds. And at the same time, each one of those has a defined rate of return. That's kind of a crazy thing to say out loud nowadays, since when they're floating the Bunds in Europe, the German Bunds in particular, they're a minus. There is no return in investment there. You have to pay to own those. So that's how that works. What else can I say about that? So then a futures contract is from the futures exchanges, and they say, oh, hey, we're going to, there's futures in corn, there's futures in soybeans, there's futures in stock indexes, there's futures in, pretty much mostly everything, rice, crude oil, heating oil, natural gas, there are all these futures contracts, and they will deliver the product of whatever it is. So if it's soybeans, then they're going to deliver you 5, depending on the size of the contract, could be 5,000 bushels. They have mini contracts, micro contracts. So there's a futures contract, and what you're doing is you're delivering it. Now, the big difference in the interest rate market in futures is you deliver the moment they float the futures contract. It has a defined delivery product and date. when you're going to drop off your physical bonds. So you're going into the open physical market, trying to buy the bonds, okay, and then you put them together and you can deliver $100,000 worth of bonds. And they have, they define which bonds they are. Let me see if I can put it up on the screen here. What they'll do is they'll define how many. Let me just see if I can find the definition for it, and that'll help you out a little bit there. Let's see, where's it at right there? Let me just double check that too at the same time, and how that works. Let's see. And so that's the way it works here. And let me see if I can find the official delivery of the futures contract. So it'll make more sense. They'll list like futures delivery. Um, 10-year treasuries? How about that? Let's see what that does. The 10-year treasury notes, futures, or 10-year notes are debt obligations issued by the U.S. government. Let's see if we can do this. And let's see if, and let's move this down for you. And so, and then what happens is that they have a list of the 10-year bonds or maturities that you can deliver. So 10-year note futures contract specs. Here we go, CME. Let's see what this says. And what they'll do is they'll list there might be 8 or 9 different bonds that they're willing to accept for this particular futures contract. And usually they have that listed in here. I can see if we can find it. Sometimes it jumps out pretty easily. Trading and settlement TAS, subject requirements. And so what it really comes down to, and I would like to show you the delivery products, because then you'll say, oh, I see, I get it now. And that'll make more sense to you. Trading hours, minimum price, product code, listed contracts, settlement method, terminating trade, TAM or TAS rules. Let's see, table, let's see. Here's a procedure. Let's get rid of that. So Treasury futures normal daily settlement, lead month. When they show, they'll show you, like they'll say like it's the, let's see, what year are we in now? We're in 2022. So that they may be willing to take, say, the August of 2015 10-year bond and deliver it for the contract. That's what I'm trying to get across to you. They may be willing to, they'll list the different maturities. That's the best word for it. The bond matures, and they'll list the different maturities that they're willing to accept. And that's what I think I'm trying to get across to you more than anything else. So they like it says here, for example, a trade date of August 31st of 2015. The December 15th quarterly futures will become lead month. Okay, that's the futures contract itself, and they actually list the different notes. Let's see if we can find the list here. They actually list the maturities. Let's see if we can find it. Let's see, margins, settlements. Let's see what the settlements are. So they'll have a list of about 8 or 9 or 10 different bonds. So it could be the year. Right now we're in 2022, okay, and March. That March contract will accept delivery of, say, the 10-year, the 10-year of 2015. It could be the December contract. It could be the not December. It probably has to be forward. So it'll be the March contract or the June bonds, or something getting ready to mature. The April, In other words, they sold them back in April of 2000, 2012. And so you might get delivery of an April 10-year bond. You might get a delivery of 2012. There might be a March bond of 2012. In other words, anything that the Treasury floated, they usually accept about 7, 8, or 9 different bonds that have been floated in a 1-month period. And so, and usually it's after March. So in other words, it would be like the bond had to be floated back in March of, say, March 20th of 2012. And they collect them all up. And that's what they're doing, is they're collecting up the actual physical bonds. And they have a list of them. They're not very quick to show you the list anymore. It used to be you clicked on it. Let's see. For more details on final settlement, click here. Let's see what that says. Okay, right there. And they'll have a whole list of the bonds themselves, but I think I'm getting the point across here. And that is that, so, so what happens is that you'll be, taking delivery. It could be April of 2012 bonds. It could be, remember, they're floating these things every 2 and 3 weeks. They're floating them all the time. They're rolling them and they're floating them, and you always hear about the bond auction. In other words, like, I guess we look at the bond auction of the Treasury right now in 2022. There's going to be auctions, and they could be every couple of weeks, and so they choose all these different 10-year bonds, and there's 10-year notes, and they'll take a couple of those, and that is the delivery of the futures contract. And that's the game they like to play. And since they're not listed, except for the futures contract, see what that says here. See, it wants me to open up they want me to open up an Excel spreadsheet to it. And so that's why we're not seeing the list. Delivery futures, cash settled, commodity, and it's not a cash settled futures contract either. So that's how that all works. So in other words, the March futures contract in futures right now is delivering X amount of bonds. Different bonds are acceptable. In other words, you could deliver $100,000 worth of the April bonds of 2012. You might be delivering $70,000 of them and $30,000 of the March 20th bonds or the March 27th bonds. Or even, I noted they'll accept a couple notes. And so they might have floated some notes back in 2012 of the 10-year notes, and that'll be delivered. And so that's how they do that. That's the game that's played. Does that make any sense to you, Jordan? Going for the tea again here. Hot tea on let's see, it's 15 degrees out. So what is that? Minus 9 Celsius, something like that. I hope that makes some sense to you. Now, we can show you a different way of delivery of, say, corn or soybeans, like soybeans. Dukascopy has the futures contract on that. Let's just go over to that real quick. And we'll show it to you here, too, at the same time. If I can find my mouse. There it is. Not that mouse, this mouse. So right here, Dukascopy is trading the soybean contract, or some of these other commodities too. But soybeans is an easy one to do. They take delivery of 5,000 bushels of soybean. Now, they could have been harvested in November or December or anything like that, and they'll take delivery of that. They call it old crop. And then, like, say the September or November beans. I guess November beans is the new crop. And, they'll take delivery of all those beans, 5,000 bushels of them. Not a moment, Jordan, not at the moment, but with some study, hopefully it will. Well, the futures contract, again, is delivery. So the difference between a bond futures delivery and, say, a soybean or crude oil is the fact that they're commodities and they're pretty easy. Whereas in bonds, it could be 7 or 8 different issuances or 9 different issuances that you're being delivered. But they're all going to be 10 years old. They're all going to be getting ready to expire over the next, the end of March, all the way up until, say, maybe the middle of April. They may. I don't think. I think they only. I don't think that they go much more than a couple of weeks of expiration, like 3 or 4 weeks. So you take delivery of the. You'll take a delivery. Let's say if you bought the bond future, the 10-year bond future, it's going to expire like going into the second week of March, and it's going to deliver bonds that expire, government bonds, actual physical government bonds, in March and probably early April, like really early. It might be only, there's a couple different auctions. Also, you could also take possible delivery of another bond, that like a 15-year bond. Can I do that? No, I don't think so. You can't take a delivery of a 15-year-old bond. I forget how that works exactly, but it's going to be maturities that all expire right around the futures contract, like days and weeks afterwards. So you take you take delivery physical of those bonds. You actually take delivery of them. You hand them $100,000 worth of currency, and now you have those bonds, and those bonds will mature in a matter of days and weeks, and the government will give you your money back. So that's how that works. And so it's an over-the-counter market to a great extent. That's the thing. It's not a listed market. The difference between a listed market is you have a listed, the bonds are listed at a specific spot. Matter of fact, the listed market to a great extent, and the secondary market is when they're floated or when they're issued, like right now, when they're floating 10-year bonds in the next couple days or weeks. That's a listed or floated market, a listed market and a secondary market right there and then by Treasury. Now, after that, those things are floating around everywhere. They're in brokerage houses, they're in banks, they're everywhere. And so they're not really listing them so closely. Everybody's watching the 10-year futures contract, and they're looking at, and also there could be a delivery problem too. Let's say there's not enough of those bonds. Let's say someone has grabbed them and is holding an enormous amount of them, and there could be a little squeeze and necessity of them, or vice versa. There's so many of them that it pushes the yield down. It just goes back and forth. It's all mechanics in the end. So if you're thinking about, floating, buying futures contracts and then going into the over-the-counter market and slowly accumulating different maturity bonds, and then and then you go and sell a futures contract, that's a good deal. Believe me, they're keeping it very tight. The arbitrage is very small when it comes to the delivery of the futures, but it's very wide. Let's say you work for Deutsche Bank, or you work for HSBC, or you work for an institution that deals with a lot of clients and they want to sell their bond. That's where the real money is made, is buying the bond from the client and then parking it to the side and delivering it for the futures contract. That's where the real money is made. And then there's corporate bonds and so forth. But the real money is being made is working for what you would call a reactive, not a proactive, but a reactive institution where clients are coming to you and saying, I want to buy an automobile and I need some cash, so I've got these bonds. I want to sell them. And you give them a quote, and you find that it's a pretty good quote in the sense of you make, not only do you charge a commission, but you're able to buy it and then go sell it again to somebody else. Jordan says, let's see, is the 30-year bond correlated to the currency market? Well, you know, at one time they were totally locked together. Now, how do I describe this? With quantitative easing, we find, let's go back to the currency market real quick up on the screen. What we find is that here is, let's look at, there's the Swiss, okay? That's dollar Swiss. Now let's look at the 30-year bond. Let's see. It's opening up now, and you'll see the 30-year bond. There's a 30-year bond. And let's say we do this. We try to put the two of them next to each other. How do we do that? I guess if we go like disconnect one to the other, maybe. Let's see. There's a Swiss. Let's copy that. I guess I'd have to open up a third. Let's do this. Let's move it down. Minimize that. I disconnect this. Is that the way I do it? Yeah, let's disconnect that. That goes here. Okay, I'm going to put them side by side. And then we could look at a couple different currencies. Can we do it this way? I guess if I do this, I got to copy it and paste it. That's what it comes down to. So I'm going to put it back like that. Copy it. Copy the window. Then we're going to go to the bond right here and paste that there like that. Now we're going to disconnect that, move that down, and we're going to disconnect that. Let's see if that does it too. And move that down. All right, there we go. All right, now let's put this. They're side by side. Here it comes. We'll show you what it looks like on J4X at the same time. Let's put the 10-year. Let's put the Swiss up on the J4X because we can use it to some extent as an example. Now, here is the two side by side, live trading. All right. Now you can see here, the dollar has been going up in value to a great extent against the Swiss for, say, the last 10 days. You know, since we've been in that daily buy. Matter of fact, it went into a sell right there. Let me just throw that in there. I'm not going to worry about it at the moment. But notice it's been going up in value. Now you can see the bond has been going down in value from the same date, say. Let's use that as so the 4th. So the 4th is right there. So the 4th, the product went down in value. You can see the closes. I guess we could use a line, really. And you can see it's rising here in the Swiss. So there's a correlation. You know, the currencies are following the interest rate market. But at the same time, as we go back up to the Swiss is right here. We go with this one right here, right there. As you can see here, the Swiss at the same time is right there. You can see the Swiss is trapped in a range. You know, so the currency pairs seem to be locked in ranges during the quantitative easing era here. At the same time, if I go like that, there we go, and we go back down to the looking at the two of them side by side, you can see that they have trends that are same. Are they locked perfectly? No, because there's more supply and demand. You know, there are companies that need to buy or Swiss francs or sell dollars, and so they'll influence the market. Obviously, the bond market is enormously more greater than the currency market, but the currency market is still a big market compared to, say, the commodities market or the stock market. So the 30-year bond correlated to the currency market, it is. It has, you can see the trend there. Now let's take a look at, let's get rid of that one and put in, let's take a look at the euro. Remember that? Yeah. So I delete that. And then I'm going to go back over to here and copy the euro and bring it down to it. So we'll go like this, copy, and it's a Swiss. I got to put the euro in there. There it is. I should have kept it over there, really. Copy, and then let's go to that and paste. And then let's disconnect it and bring it down. All right, now there's the euro. And you can see there, whoa, didn't mean to do that. Bring that down, like so. And go like that. And you can see there on the fourth, let's see where the fourth is on that. There's the fourth. You see it's just been one steady grind down. You can see the same thing here on the fourth and one steady grind down. Now there's been some pops. You can see where they, on the 14th, it went and challenged, you know, close to the close of back here. Whereas the 14th there, the 14th right there, didn't get back up into this range whatsoever. So they have trends. I noticed that the range between thinking about why the markets range and what can cause it from a fundamental aspect. True, no doubt about it. Usually, in the old days, before quantitative easing, the range was defined because of interest rates and inflation. Does that make sense to you? But in the new era, quantitative easing, the objective of quantitative easing is stability. That's what that's all about. That's what they say, stability. The objective is stability. So, so the range is kept in line by all the central banks, and the U.S. Treasury actually announces if someone is manipulating the currency. And I'm assuming the only way they can define that is the price, of course. And if it moves in or out of a range that they define as manipulation. Does that make any sense to you? Does that make any sense at all? I'm tempted to go after my tea again, but I'm waiting for your response. So anyway, when it comes to, let me get rid of these two here. Yes. And then park this back up again. So there we are. So when you're trying to understand the bond market, you have to imagine we're living in an era where return on investment is not necessarily there anymore. It's the opposite, just return of principal. That's what they call investment would be interest paid or appreciation or dividend paid when you buy something, okay? Whereas principal returned is what pretty much something like 14 trillion that is invested in right now. Okay, good. Not really, but I'm sure it will with more research, exactly. So in other words, we're in an era now where return on investment is not normal anymore. And instead, what is taken over is return in principal. So in other words, principal is when you buy something for $100 or 100 euros or 100 Swiss, and you're guaranteed that you'll get your 100 Swiss back. That's what that's about. Whereas return on investment means that you bought something for 100 euro or $100 or 100 Swiss, and you get nothing. You don't get anything. You don't get a return in investment because they're only pretty much to a great extent across the planet, minus the United States and a few other places, they're not guaranteeing return on investment anymore. They don't pay interest or a dividend. Now, there are plenty of stocks. That's why the stock market is so popular, because they are paying a lot of dividend because they have a lot of cash flow. But not like the 10-year Bund. Let's see where the 10-year Bund is right now. I think it's minus a quarter percentage point. So when you buy that bond, the only thing you're getting is return on principal. You're getting your, you're getting your 1,000 euros back, but you're not getting any interest on it. You're not getting any, profit. Just return of principal. It's a simple concept. It's just that in an era where the media and the governments and the environment itself, because of QE, they really hide the story. It's there. It's just hidden. That's all. Not that hidden. So you see the difference between return in principal versus return in investment. They used to be a real conversation point. In the era of quantitative easing, they're not really. What did Janos call it yesterday? Theft and stealing. Pretty much that's what it really. In pre-2008, it would be called theft or stealing. In 2009, going forward, it's called quantitative easing. Is that crazy or what? All right. I'm going to jump back over to the currencies. But if you have any more questions, just ask them. I'll gladly answer them. All right. So from there, we go to the euro. You can see the euro, is moving. The euro is moving down. It's kind of, well, actually today it's popping back up again. You can see, but we're at a daily sell since here. So it's kind of the downwardly draft. We went into the weekly sell on Friday, or somewhere in the middle of that week, and the end result is that you can see there's just a mild little drift down. Let's see this. You can't see that. There you go. Now you can see it right there. And let's put it up on J4X. So return on principal is the way the world moves nowadays, and the return on investment is kind of non-existent. It doesn't really. It's happening in different places and different products, but it used to be on everything, and it was a decision-making process. Why you would buy one thing versus another was because of the return on investment and principal. In other words, how much of a chance you were going to get your money back, and how much money were you going to make on that investment. Now, like I said, there's like 14 or 15 trillion, not billion or million, trillion in bonds that are just guaranteeing the return on principal, and there is no return on investment. You're not making any money from it at all. You're losing money. That's really weird saying that out loud. No wonder the media doesn't want to talk about it. It's an insane concept. I have to laugh at it, honestly. All right, from there, let's go over to the cable. See what the cable's doing. There's the cable. You see the cable's trying to lift up a little bit today. It closed in the daily sell right there yesterday. Let's put that in there. And you can see it's still in that weekly sell since this week right here, right in here. And notice it's pretty much not going anywhere. It went down a little bit, came back up to it, has drifted, but pretty much, we've talked about this, these products are in a sideways action, just standing around doing nothing, because a combination of Crimea and Kyiv and interest rates flattened, and central banks talking about, fighting inflation, and inflation. We come in on Monday, and all of a sudden they're talking about not raising rates because they don't want to disturb the growth of the world economy. I mean, that is part of the process. That's what QE was all about. People don't realize that the world financial markets collapsed and are gone, and but there are remnants of them, and so they're trying to make it look like they still function. Jordan says, cheers, I will look into the futures a bit more. Now, futures, like I said, is just a contract. And it's just delivering the underlying product. So in other words, if it's a bond future, it's delivering a group of bonds, of maturities. Normally, it's anywhere from 8 or 9, something like that, 7, 8, or 9, depending on the floats that occurred previously. You know, if it's soybeans, then it's going to be soybeans, 5,000 bushels if it's a 5,000 contract, or if it's smaller, then it's, you know, it'll be a smaller quantity. Or oil, delivering West Texas Intermediate versus delivering North Sea Brent. You know, what else is there? I mean, there's cocoa, cotton, sugar. There's all kinds of different things delivering the actual. Then the stock indices don't deliver the stocks. They deliver a basket of money. But what they try to do is they try to hedge it with stocks. You know, you try to buy the whole, you try to buy an index, and you try to, so you buy all the stocks in that index, and so that means you're taking the dividend in. And then you go sell the futures contract. That's why futures are traded discount, because they discount the difference between the dividend and the contract itself. That's, you know, that's the name of the arbitrage situation going on there. I hope that one didn't freak you out. So let's say you're looking at the S&P 500. You go out and you buy all the S&P 500 stocks equally in balance to the futures contract. You know, so every tick is the same tick. Now, at the same time, you're taking delivery of dividends. Obviously, you're buying it on margin, so you have an interest rate cost of margin. And at the same time, you're taking in dividends. And the idea is to beat the margin, you know, taking in more money in dividends than it is in margin. And so then, from there, you go and sell the futures contract. Now, if there was a premium on the futures contract, that'd be like getting an extra dividend. But due to the fact that they're discounted, you know, to compensate for the interest rate factor and inflation, then it's a minus. So, in other words, if we go and look at the, what is it, the Dow Jones Industrial Average is trading at 34,566, and let's go find the futures contract there. And they have a dividend yield and so forth. So right there, the futures contract is at 34,000. Where's it at? Is it okay? So that has a, that has a premium to it, 34,866, and the futures contract and the actual physical contract is at let's see, it's trading at 34,900 and something. So it's discounted by like, you know, like 100 and some odd points. Yeah, index is like a basket of shares. Exactly. Exactly. All right, where did we leave off? Oh, let's check out, let's see what the Turkish lira is doing today. I'm sure it's stable. We're just going to go to the Euro Turkish lira and look at that. It's just stable, hanging out in there. Maybe we change that like that. No, that's not it. Cancel. Cancel. Let's make it so you can see it even better. There we are. How's that? There we go. So you can see it's just very stable, up a little bit. We're in a little buy there. We're in a weekly buy, but barely. Over on J4X, let's put the Turkish lira up there. You know, same thing. You can see it's in that nice tight range, just like this. Why does it do that? Don't do that. There we are. You can just see in that nice tight range. They're not going to go anywhere. They've come up with a really smart concept. The idea of a free put. It really does. It does make a lot of sense. And you know what? I'm surprised a lot of other. I mean, the central bank, the Federal Reserve and the ECB have been doing it since 2008, 2009, but in an unofficial way. And you would think that everybody else would have joined in. And finally, that's probably what gave Turkey the idea back in 18. His son-in-law, who came up with the idea, that's Erdogan's son-in-law, it was a veteran of the financial industry. So, he probably was like, why are we taking all our money and giving our cash away, to prop up our currency? Why are we using all the sovereign fund? Why are we using all our bank reserves? Let's just give a free put out. And it's a very small increment compared to having to pay all that money. And at the same time, it makes it much easier for investors to hold your currency. And that's the real key right there. They want people to be invested in their currency. I mean, really, that's what it's all about. I mean, that's the answer to it all. So, in other words, someone comes in and buys Turkish lira, you want them to hold on to the Turkish lira. You don't want them flipping it out 2 days later. And so then that money's being invested in the country, opens up the doorway for commerce. And so then if you increase commerce and business in your country, then you can afford to raise taxes. It makes total sense. It's the name of the game, really. I'm surprised other places haven't done it. I don't even understand why South America doesn't do it. Who did we have on here? Last week we had somebody from Chile for a couple of days talking. We were looking at copper and so forth. And I was like, and he's in. He left Chile and he's on the East Coast now, and Chile's on the West Coast of South America. And I was like, why don't they all just float puts, give puts out, instead of declaring insolvency all the time and having to reinvest and all that money lost? I mean, it makes a lot of sense to me. All right, from there, we go over to the Canadian. Boy, Trudeau did some crazy stuff. He declared some type of state of emergency. I think he's going to lock up the truck protesters or something like that. You can see here, the product has been doing the same thing as all the other products, really. They're all sideways. They're not really, just like that is sideways, and all the currencies to a great extent are sideways at this point. I don't think I think they're probably stunned to some extent. I would think that they are literally stunned in the sense of the Federal Reserve is not openly going to war against inflation. They think that they can cut back on floating more bonds or something like that, or buying more bonds, or I don't know, something like that, and they don't have to raise interest rates. Remember, their main goal of quantitative easing is for stability. That's what they're there for. That was the whole objective. That is that's the whole enchilada. All right, from the Canadian, normally we would relate to the oil or the gold, and we'll give you a quick look at those two. We'll leave Canadian up on the screen there. You see gold coming down after Mr. Putin pulls out 10,000 troops. Whoop-de-doo. As Janos and I have said here on the webinar, it's been a great way of, what did he say yesterday? Janos said that he's the head analyst for Dukascopy. He said that the Russian defense budget is $48 billion a year, and the oil market made $65 billion from this military training / invasion thing. And so they basically paid for their military budget for the year. So you just move your troops to the border, build a couple buildings, get the West, or get the Europeans and the Americans all nervous, watch the prices get driven up, they make their money back. It's like a return. It's a return in investment. Mr. Putin understands return in investment very well. It's too bad that some of the Western leaders don't understand it. All right, from there, we'll take a look at oil. It's probably doing the same thing as gold, and it is trying to move down, but it's still in the buy. And you can see it's in that long weekly thing, whereas gold, you know, you can see it here, is flirting with the weekly sell. And whereas you see over here on J4X, right there, you see it's just kind of, you know, Canadian is just inching its way up, which is normal when these things are going down in value. But there's a lot more to it, of course, in this sense, is that Mr. Trudeau is doing some really strange things. It's going to be interesting. I don't know if the Parliament's going to survive or not survive. I don't know. It'll be very interesting. See how that all plays out in the end. All right, from there, we go over to the Rand, and you would think that the Rand would be moving up against the dollar. Let's check it out. ZAR right there. And it is, it's moving up today. Let's see what it looks like on J4X. Oh, let's put the lines in there too. There we go. Whoa, how'd that happen? There we go. South African Rand, right there. It'll catch up with our work over here soon. You can see it here. You know, it's trying to move back up, of course, because the metals complex and the war threat is all starting to disappear, and so that's just automatically forcing everything to back off. Let's see, what else can we say about that? I guess that's about it. Let's go over to the yen. This could be curious. Yen looks a little firm there. I would say it's pretty much unchanged. That's what it, you know, I mean, shows it to be firm, but I'm sure that's how it's acting. Oh no, look at that. Our work is trying to break down. And you can see here it's lifting up a little bit here, just like it is on J4X, right there. And you see the lines are trying to move down, and our lines are trying to move down here. As you can see right there. And you can see the weekly is giving it a quick lift again after sliding into a weekly sell last week. It's doing a quick push back up again. I'm really curious about that one. You know, we're looking at 5-year highs, and it doesn't seem to want to move away from it. So something is brewing there. It's definitely something we're going to keep an eye on, is the yen. And we might want to talk about that, Robin. If you're in the room, I think that might be part of the article we're going to write. Be the yen, how the yen is at a 5-year high, and it doesn't seem to be wanting to move away from that. And we can post a chart of that too at the same time. Let's see. I think today's webinar will be, since we talked about the bond market, we'll probably, you know, label it as a bonds versus bond futures or something like that. And then let's see, where do we go from here? We'll go take a look at the Mexican peso, which seems to be moving totally comfortably back into its range. You see that? There's that downwardly pressure again. I would imagine that whatever Mr. Trudeau and Mr. Biden and the president of Mexico talked about in the end has cleanly removed this panic thing we saw right there during the Biden negotiations with the two countries. And you can see it's falling back into its range here. And you can see it didn't come down and touch here, but it did move back up and touch there and then moving down again. So we are dead center. And matter of fact, we're just a little bit underneath dead center at the moment. And that's the peso has and was strong against the dollar until recently. All right, what else can we say about any of these traders? Anybody want to see any particular product? Hey, Jordan, since you're here, why don't we go look at this one? This is one of my favorites also. And if Robin is in the house, we may be looking at this one too, the GBP JPY, where it's doing the same thing. It's trading against a 5-year high also there also. Is it a 5-year high? Let's take a look at it over on J4X real quick. We're going to go back, 5 years and take a look at it there. GBP, JPY, right there. Make this the whole page. Make this a monthly. And it's loading up. And that's how we'll pretty much end this particular webinar. And, well, as it's loading up, whoop, didn't mean to do that. As it's loading up there, you can see it here on J4X. I'm sorry, not J4X, on the Chicago Quant. It's trying to move back up into the weekly buy also right there. And at the same time, the sideways action pressures going on right there. But it is, let's see, how's it? It's the other one too. So let's see what the dollar one is. Right there. Same game. A little pressure on the short term. But the weekly is really starting to make a nice dash. Here you go. Here is the, this is going to go back to 2017. We've taken out the 2018 January high. And we're in 2022. So it's a 4-year. And there is 2016 right there in May. So it's going after a 5-year high also in this thing too. 6-year high. Going after a 6 year. So 2017 is a 5-year high. It's taken out the 5-year high. So we're seeing that pressure on this product. Seems like something's going on there. This is pre-Brexit, right? At this point? Before they even came up with the idea of Brexit. I mean, they talked about it, but they say, yeah, I've got the monthly chart up on GBP JPY. I still have to go from go to the through the chart, yeah. So you can see there that they're going after something. I mean, it seems odd, but I mean, we're seeing the dollar get stronger against the yen. I don't know what's that all about, but we'll see. That's not bad there. You can see what happened in 2017. The lows have been pretty consistent, and you can see it over here too. Pretty low, consistent, higher lows. That's all the way back to 2003. You can see there, it was 250 yen to the dollar. I remember when it was 800 yen to the dollar. All right, traders, we're out of here. Let's see, what's that? The dollar Swiss. Jordan says, was on dollar Swiss for most of the night tonight. Oh, I mean, you were long it. It seems to be pretty sideways, most of these products at the moment. None of them seem to be really exploding. They all seem to be stuck in their ranges. You can see it here. There's the dollar Swiss. Right there. They seem to be pretty tight. And when you really look at it overall, it's staying inside its range with not much of a problem over the last, year or so. I mean, it did dip up here a little bit, but it also made a lower, I guess it was played with the lower part here. And you can see they're staying inside these ranges. This is going back to, this is August of 2-1, there's back to June of 2-1. I guess the biggest noise of all was when they disconnected from the euro. That was probably like the biggest of the noises of them all, All right, traders, we're out of here. This is Doc from North America. Catch you all tomorrow on Wednesday. Happy Hump Day. Happy trails to you all. Happy trails to you until we meet again, which will be Wednesday. Happy trails to you, to all our trading friends at Dukascopy and the world. Ta-ta for now.